Enjoying two AIs debating the markets every week? Like, share, subscribe, not for the algorithm, for your smarter self, every Sunday. This is the Weekly Market Podcast, zero fluff, just signal.
The past week certainly gave us a lot to chew on. We saw some pretty significant moves, some data points that frankly surprised, and signals that are, well, absolutely crucial for figuring out what's next. So our mission today, simple. Cut through the noise, give you the clear picture of what actually happened, why it matters, and what you really need to keep your eyes on going forward.
That's right. And on the surface, it looked like another pretty good week. Global markets rallied again.
Yeah, second week in a row.
Driven by things like that better-than-expected U.S. jobs report, the ECB finally delivering that rate cut we all anticipated.
And hopes for more stimulus in China, too.
Exactly. But like you said, dig just a tiny bit deeper, and it gets way more complex, doesn't it? You've got these mixed economic signals bouncing around. The whole inflation question still kind of hangs in the air.
It's definitely not as straightforward, all clear.
Not at all.
Which makes it fascinating. So here's the plan. Quick tour around the world, region by region recap. Then we'll pivot hard to next week's absolute must-watch moments.
And finish up by pinpointing the top risks that could, well, potentially shake things up a bit.
Sounds good. Let's start with the big picture for the week ending June 6th. Global markets up for the second straight week.
Yep. And the main catalysts seem to be that resilient U.S. jobs data. We'll get into the details, easing inflation numbers out of the Eurozone, which paved the way for the ECB cut.
And those China stimulus hopes you mentioned.
Right. That ECB rate cut really felt significant, didn't it? Potentially a real policy turning point over in Europe.
It did. But then there's that nuance you touched on. Beneath the rally, you still see weakness in manufacturing pretty much everywhere, and services inflation. Still sticky. Central banks are definitely still worried about that.
Absolutely. It's the tricky part of the equation right now.
Okay, let's dive into the regions then. Starting with the U.S. markets. Equities had a solid run. The S&P 500, tracking the big guys, climbed just over 2%. The NASDAQ, heavy on tech, up 2.18%. Dow Jones Industrials added 1.17%.
And even the small caps, the Russell 2000 had a really strong week, jumping 3.19%.
So pretty broad gains. What was really driving that performance?
Well, it feels like two main things. One, just continued momentum in the tech sector. That story isn't going away.
Right.
And two, that official jobs report that came in, well, better than many expected.
Yeah, the May non-farm payrolls, that's the big one everyone watches. Came in at plus 139,000 jobs added. Beat expectations.
It did. And even though they revised March and April down a little bit,
Tiny revisions, yeah.
the headline number was strong, and the unemployment rate held steady at 4.2%.
So that grabbed the headlines, suggesting the labor market's still humming along.
It certainly did. But, and this is key, you got to look at the other signals too, they weren't quite as rosy.
Like the ADP private jobs number.
Exactly. That showed a much softer gain, only 37,000 private sector jobs. And weekly jobless claims, they ticked up slightly by 8,000 to 247,000. So hints of cooling there.
And it wasn't just the jobs data sending mixed signals, was it? We got those ISM surveys, too.
Right. The ISM Services PMI, that's the pulse of the biggest part of the U.S. economy. It actually slipped. Fell to 49.9.
Below 50 means contraction, first time in.
Almost a year, so that's significant. And the manufacturing PMI dropped again. Third straight month. Down to 48.5, so also contracting.
Okay, so putting it all together for the U.S., what's the main takeaway?
It seems like the labor market, while maybe, just maybe, showing a few cracks around the edges in some of those other surveys.
The ADP, the claims.
Yeah. It's still seen as resilient enough, especially based on that official payroll number, that it's basically pushed back the timeline for Fed rate cuts. The market's now really looking at September, not July.
Makes sense. The strong jobs number kind of overrides the other weaker bits for now in terms of Fed expectations. Okay, let's hop across the pond. Eurozone markets, they rallied too last week.
They did. The Stochastic Europe 600, the broad index, up 0.90%. Germany's DAX gained 1.28%. Italy's FTSE MIB matched that at 1.28%. France's CAC 40 up 0.68%.
And the UK's FTSE 100, which we'll get to separately, also saw a gain of 0.75%.
Yeah.
So what was the driver in the Eurozone? Pretty clear, wasn't it?
Oh, yeah. All about the ECB. The European Central Bank finally did it.
A rate cut. Everyone was waiting for it.
Cut the deposit rate by 25 basis points, 0.25% down to 2.0%. And Lagarde, the ECB president, had that interesting quote saying the policy cycle is nearly concluded.
Suggesting maybe not many more cuts coming soon.
Possibly. Or maybe just signaling the peak is definitely behind us. The inflation data certainly helped them make the move.
Right. Eurozone headline inflation dropped to 1.9% year over year.
Yeah.
That's basically at their target. And core inflation, stripping out food and energy, eased to 2.3%.
Much better numbers, allowing them the room to cut.
And we saw an upward revision to Q1 GDP growth too, didn't we?
We did. Revised up to a pretty healthy 0.6% quarter-on-quarter growth, helped by places like Ireland and Germany looking stronger.
But there's always a but, isn't there?
Usually. And the but here is industrial output. It actually fell in April in both Germany and France, dropped 1.4% month-on-month in both.
So manufacturing and industry still look weak.
Exactly. So the Eurozone picture is inflation looks like it's behaving, ECB delivered the cut, maybe one more coming later this year, perhaps September.
But underneath, you've got these signs of growth weakness widening out, especially in industry.
Precisely. Okay, shifting gears to the UK. The FTSE 100, their main index, had a more modest gain, up 0.75%.
And the economic backdrop there just feels, I don't know, a bit foggy, some strength, but also some definite cracks.
Yeah, blurry is a good word. The official unemployment rate ticked up a bit, 4.5% in April. And the HMRC payroll data actually showed a drop, 33,000 jobs lost on payrolls.
But wages are still high.
Still quite firm, yeah. Average earnings up 5.5% year over year. That's still pretty hot.
And overall GDP growth was okay in April.
Modest, 0.2% growth month on month. Got a bit of help from construction and retail.
So for the Bank of England, it's complicated. They might want to cut like the ECB.
They're probably leaning that way, yeah, dovish.
But with wages that high and services inflation still proving sticky, cutting rates is risky, isn't it?
Yeah.
They don't want inflation flaring up again.
Exactly. Makes the timing really difficult for them.
All right, let's swing over to Asia, starting with Japan. Their stocks actually slipped last week.
Yeah, a bit of a down week. Nikkei 225 off by 0.59%. The broader TPX index down 1.15%.
Why the pullback there?
Seems mostly tied to some mixed Q1 economic data. The overall annualized GDP growth looked all right, 2.2%.
Okay.
But the crucial part, consumption, personal spending, flat. 0% growth.
Ouch. That raises questions about domestic demand, doesn't it?
Big time. Questions about whether the recovery is really solid domestically. Meanwhile, you still have price pressures. Producer prices for May came in hotter than expected, up 4.0% year over year.
So costs are still rising for producers. And what's the Bank of Japan doing amidst all this?
Still treading very carefully. Governor Ueda signaled they'll keep tapering their bond purchases, slowly reducing that stimulus. Though there was some talk about maybe slowing down the taper pace in 2026.
So Japan's story is kind of uneven recovery. Domestic demand looks shaky, and the BOJ is trying to normalize policy super carefully.
That sums it up pretty well. Uneven is the word.
Okay, last stop on our world tour, China. Their markets actually did pretty well.
Yeah, they advanced. Shanghai Composite up 1.13%. The CSI 300 gained 0.088%. And Hong Kong's Hang Seng had a strong week, jumping 2.16%.
Interesting. What drove the gains in China? Because some of their data wasn't great.
Right, exactly. It was actually the soft data that fueled the rally. Weak inflation numbers, manufacturing still contracting. It basically spurred hopes for more stimulus from Beijing.
The classic bad news is good news for stimulus bets in China.
Pretty much. We saw May CPI actually negative year over year, down 0.1%. PPI also negative, down 2.7%. Still deflationary territory.
Although, weren't those numbers slightly less bad than some feared?
They were, yeah, higher than the absolute worst fears, but still negative. On the positive side, trade data looked decent. Exports rose 8.1% year over year in May.
That's pretty strong. And a big trade surplus, too.
$96.2 billion surplus. But the market focus wasn't really on trade. It was on that weak manufacturing data, like the Caixin PMI, still stuck at 48.3, contracting.
And that's what's feeding the stimulus hopes.
Absolutely. That factory weakness plus the deflation risk, it just reinforces the expectation that the government's going to have to step in with more support, especially if global demand starts to wobble.
Okay, so China. Yeah. Deflation risk and factory slowdown equals stimulus bets getting stronger. Got it.
All right. That wraps up our look back. Shall we pivot to the week ahead, June 9th to the 14th?
Let's do it, because this coming week looks absolutely packed. Crucial data, central bank talk. What are the absolute highlights we need to watch?
Top of the list, no question, has to be the U.S. inflation data. We get both CPI, the Consumer Price Index, and PPI, the Producer Price Index.
These are huge, right? They could totally change the game for that September Fed rate cut expectation.
Completely. Confirm it, delay it, maybe even take it off the table if the numbers are hot. That's number one.
Well,
We need to listen really closely to the ECB speakers. After the cut, what's the tone? Are they hinting at a pause now, or is this the start of more cuts coming? Their communication will be key.
Makes sense. What about Japan?
Keep an eye on their consumption and services data. Is wage growth actually keeping up with prices? That's still the big question for their recovery.
And China?
The vehicle sales figures for May could give us a clearer read on whether domestic consumers are actually spending.
Okay, so quick rundown of the schedule. U.S., Wednesday is the big one. May CPI. Thursday, May PPI. Friday, the early look at June consumer sentiment from University of Michigan.
Yep. Europe, lots of ECB speakers all week. Elderson, Bukulain, Cipollone, Schnabel, Guindos, listen to them all. Friday, we get final CTI inflation numbers from Germany, France, Spain, Italy.
Japan. Monday, final Q1 GDP looking closely at consumption and investment revisions. Friday, final industrial production and that tertiary industry index for April.
And China. Busy Monday with May CPI, PPI, exports, imports. Then Friday, May vehicle sales.
Okay, that's the calendar. Now for the fun part. What could go wrong? What are the potential landmines out there this week? The risks that could really move markets?
Yeah, let's talk risks. We've pinpointed 5 key ones to have on your radar.
Veamos. Risk number 1.
Sticky U.S. inflation. We keep coming back to it because it's that important.
Right. If Wednesday's CPI is hotter than expected.
Boom! That September Fed cut could evaporate very quickly. Market expectations would shift dramatically, potentially looking towards 2025 even. Huge risk this week.
Okay. Risk number 2.
A surprise drop in U.S. consumer sentiment. That Michigan number on Friday.
Why does that matter so much?
Because consumer spending is like 2/3 of the U.S. economy. If consumers suddenly get gloomy, it throws serious doubt on that whole soft landing narrative. The idea the Fed can beat inflation without causing a recession. Weak sentiment raises recession fears.
Got it. Risk number 3.
China's export recovery fades.
But didn't you say May exports were strong?
They were, but the risk is that it was temporary, a blip. Given trade tensions, maybe slowing global demand, if future data shows that export strength is already fading, it's bad news not just for China, but for global trade, emerging markets, industrial sectors worldwide.
Okay, makes sense. Risk number 4.
Japan's recovery loses momentum domestically.
This ties back to that flat consumption number.
Exactly. If the data this week, especially that tertiary index on Friday, which tracks the service sector, shows domestic demand is still weak or flat, it makes people question the Bank of Japan again. Are they tightening too soon? Do they need more stimulus, not less? It fuels skepticism.
All right. And the final risk, number 5.
An ECB communication shift. Hawkish surprises. Right now, markets are pretty comfortable thinking the ECB cut once. Now they'll probably pause, maybe cut again in September. But if the ECB speakers this week sound unexpectedly worried about inflation sticking around, or signal that more cuts are unlikely or far off.
More hawkish than expected.
Exactly. That could cause a real jolt, especially in European bond markets that have rallied quite a bit on the expectation of easier policy.
Okay, 5 key risks to watch.
Yeah.
Sticky U.S. CPI, weak U.S. sentiment, fading China exports, weak Japan domestic demand, and hawkish ECB talk.
That's the danger zone for this week. So wrapping it all up, the main message heading into this week is it's crunch time for global rate expectations.
Inflation data, especially U.S. CPI, is absolutely critical. And the ECB has made its first move, but now the communication is key.
Yeah, the market momentum feels pretty positive right now, doesn't it? Riding on those hopes for rate cuts, maybe some stimulus.
It does. But as we've just laid out, there are definitely some macro landmines still scattered around.
And volatility could snap back really fast. An upside surprise in U.S. inflation is probably the biggest trigger, or if those ECB officials suddenly sound a lot less keen to cut again soon.
So, final thought to leave everyone with. We see these central banks kind of going in different directions, right? The ECB cuts, the Fed's on hold, but maybe leaning towards a cut. The BOJ is slowly tightening. What does that divergence tell us about the overall health of the global economy right now?
It's a really interesting question. Different speeds, different problems.
And looking just at the next few days, what's the one single piece of data you'll be watching most closely?
Something to definitely think about as the week gets going.
Absolutely. Thanks for joining us for this deep dive.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format. AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.